$15.7 billion in cash plus a 65% equity stake. Unilever is absolutely robbing McCormick blind.
Robbing them? McCormick just secured $20 billion in projected revenue. The real story is Unilever quietly carving out their India operations.
Oh, come on. Keeping India is just smart. They're going to spin that off later for a fortune.
It's a massive red flag buried in the fine print. But fine, if you want to talk about overpaying, let's look at Apollo dropping $10 billion on private jets. The rundown.
$29 billion for Restaurant Depot. Cisco is not playing around.
It's a massive land grab. They're basically buying the entire wholesale food supply chain in one swipe.
I used to go to Restaurant Depot for bulk ribs. Now it's a $29 billion enterprise value. Make it make sense.
Consolidation, Nate. Speaking of which, pharma is having a week. Biogen is dropping $5.6 billion in cash for Apellis.
Pure panic buying. Biogen desperately needs to diversify that revenue stream. Their rare disease pipeline was looking a little thin.
Panic buying or not, it's an all-cash deal. And right next door, Eli Lilly is paying up to $47 a share for Centessa. That's a $7.8 billion check for neuroscience.
Neuroscience is the new weight loss drug. You heard it here first.
I highly doubt that. But let's talk about the deal that actually made me laugh this morning. Apollo buying Atlantic Aviation from KKR for $10 billion.
Why is that funny? It's prime resilient infrastructure. High net worth luxury travel is bulletproof.
It's private equity playing hot potato with private jet terminals. KKR bought this, held it, squeezed the margins, and now Apollo is paying a massive premium.
KKR drove a notoriously hard bargain here. The gossip is they refused to budge on valuation. Apollo wanted it bad enough to pay up.
$10 billion for tarmac access. I need to see the multiples on this because I guarantee you the math requires some very creative assumptions about private jet traffic over the next decade.
Spoken like someone who flies commercial.
I fly premium economy, Nate. There's a difference.
Sure there is, but if you want creative math, we need to look at the food sector again, not Cisco, the Unilever carve-out.
Oh, the McCormick deal. The structure on this is fascinating. Unilever gets $15.7 billion in cash plus a 65% equity stake in the new combined entity.
A total masterstroke of portfolio optimization, but the real gossip, they carved out the India operations entirely.
Exactly, which tells me they're prepping a separate, highly lucrative spin-off for the subcontinent down the line. I'm pulling the regulatory filings right now.
Antitrust watchdogs are already sharpening their knives on this one. We need to tear this structure apart. The big one, $15.7 billion in cash, plus a 65% equity stake. Maya, I read the terms on this Unilever deal 3 times over my coffee, just to make sure I wasn't hallucinating.
It is a staggering amount of capital. McCormick is basically swallowing Unilever's entire foods division to create this $20 billion revenue behemoth. But honestly, I keep staring at that 65% equity number and wondering who is actually buying whom here.
Exactly. It feels like Unilever is just renting McCormick's management team to run their mayo and bouillon brands and making McCormick pay them $15.7 billion for the privilege. It is pure corporate judo.
I wouldn't call it renting. McCormick gets global scale overnight. They become the undisputed king of the flavor aisle. But the detail that actually made me sit up wasn't the cash. It was what they left on the cutting room floor.
The India operations?
Yes, Unilever is completely carving out their India food business from the transaction.
Which is a brilliant move. My old banker group chats are buzzing about this today. The whisper number is that Unilever knows the India business is growing so fast, they want to spin it off separately in a year or two for an absolute premium. Why dilute that regional growth by mixing it into McCormick?
Oh, come on, Nate. You always jump straight to the sexy secret spin-off theory.
Because it is usually the right theory.
Look at the regulatory reality. India's foreign direct investment rules and local tax structures for corporate carve-outs are notoriously brutal. McCormick probably looked at the compliance costs of integrating the Indian supply chain and just said, no thanks, we are passing on that. It is a headache avoidance strategy, not some master stroke of portfolio optimization.
Masterstroke of portfolio optimization is exactly what the analysts are calling it this morning, Maya. Don't hate the player.
I don't hate the player, I just read the risk factors. You really have to wonder how antitrust watchdogs are going to look at this whole thing. You are combining the biggest spice company on earth with a packaged food giant. The supermarket shelf dominance is going to trigger some serious scrutiny.
Regulators will definitely circle the wagons, but as a defensive play for Unilever, cashing out nearly $16 billion while keeping majority upside is just beautiful structuring.
It is a great deal for Unilever. I just want to see the actual filings before I crown anyone a genius. The projected $20 billion in revenue for 2025 assumes absolutely zero friction in mashing these two massive corporate cultures together.
Mixing the spices with the mayo, sometimes you get a perfect aioli, sometimes it just separates and ruins the sandwich.
That was a truly terrible analogy.
I know, I felt it falling apart halfway through. But speaking of massive cash piles, McCormick isn't the only one throwing billions around today. Apollo is apparently getting very close to writing a $10 billion check for some private jets.
Right, the Atlantic Aviation buyout. KKR is sitting on the other side of that table, and I hear they are driving an incredibly hard bargain. Voices.
I'm reading this note from an analyst calling the McCormick and Unilever deal, quote, a masterstroke of portfolio optimization.
Well, sure. If your definition of optimization is handing Unilever $15.7 billion in cash and letting them keep a 65% equity stake in the new company.
See, I actually agree with the analyst here. Unilever gets a massive cash windfall, but they still get to ride the upside of a $20 billion global flavor powerhouse.
It's not a masterstroke, Nate. It's a partial exit disguised as a merger. Look at the carve-outs. They completely excluded the India operations from the deal.
Which is smart.
Exactly, but it changes the narrative. Unilever knows India is their highest growth market. They kept it separate so they can spin it off later for an even bigger premium. The analysts are missing the real play.
Okay, fair point. They protected the crown jewel. But speaking of massive premiums, we have to talk about the whispers around Apollo and Atlantic Aviation.
You mean the $10 billion private jet parking lots?
Private equity insiders are calling it a play for, quote, resilient infrastructure and luxury travel assets. KKR apparently drove a brutal bargain to maximize their returns here.
I just cannot get over that number. $10 billion.
They aren't just parking lots, Maya. They pump the gas, they cater the food, they charge obscene landing fees.
Resilient infrastructure for the 1% of the 1%.
I used to build these exact pitch decks. You project a 3% increase in Gulf Stream traffic, and suddenly the valuation goes straight to the moon. The cash flow is wild.
And you wonder why I spend my life reading the footnotes on your old pitch decks. The math is always built on a fantasy.
You just love finding my flaws.
It's a full-time job. And speaking of looking for flaws, the antitrust watchdogs are going to have a field day with McCormick.
Oh, absolutely. The regulatory filings drop tomorrow, and we also need to watch for Apollo's finalized terms. Let's see if that $10 billion holds up. Spill the tea. You just know the partners at KKR and Apollo are negotiating this Atlantic Aviation deal from the actual private jets.
Oh, absolutely. Just texting each other offers from 30,000 feet. But $10 billion for private jet services. I get that high-end infrastructure is supposedly resilient, but KKR is absolutely squeezing Apollo here.
Look, KKR knows exactly what they have. It is a prized asset. If you are Apollo, you pay the premium because you want that monopoly on luxury terminal space. It is classic private equity one-upmanship.
I completely disagree. Apollo is overpaying. Look at the macro environment. You think private jet traffic is immune to a corporate cost-cutting cycle? They are buying at the absolute peak of the luxury travel narrative.
Rich people always want to skip the security line, Maya. That is a fundamentally recession-proof business model.
We will see how recession-proof it is when the debt matures. But speaking of squeezing every last drop of value out of a deal, did you catch the India carve-out in the Unilever-McCormick transaction?
The food mega merger. McCormick is handing over $15.7 billion in cash and a 65% equity stake to Unilever.
Right, to create a $20 billion flavor powerhouse. But if you read the fine print, Unilever completely excluded their India operations from the combination.
Wait, really? They carved out an entire subcontinent?
Yep, they sold the estate but kept the guest house that happens to sit on a gold mine. The rumor mill is already spinning about a separate, highly lucrative spin off just for the India business down the line.
That is actually brilliant corporate maneuvering. You get your massive cash windfall today, and you set up a second payday for tomorrow.
It is incredibly smart, but it also makes you wonder what antitrust watchdogs are going to think about the rest of this massive consolidation in the food sector.
Which is exactly what we need to watch out for as those regulatory filings drop tomorrow. Tomorrow's radar.
I'm refreshing the SEC site tomorrow morning specifically for the McCormick Unilever filings. Antitrust watchdogs are going to have an absolute field day with this.
You really think so? It's just soup and spices. I'm way more focused on the India carve-out. Unilever keeping the subcontinent business out of the deal is a masterclass in staging a future spin-off.
Oh, come on. You don't think that carve-out was to appease regulators? They knew a global monopoly on bouillon cubes would trigger an instant block.
Spoken like a true skeptic. I'm telling you, it's a pure valuation play. Meanwhile, I'm waiting for the official ink on Apollo buying Atlantic Aviation from KKR. $10 billion for private jet parking.
10 billion. KKR really squeezed them on that one.
Squeeze them dry. Turns out private equity guys will pay any premium to control the tarmac.
Speaking of wild premiums, we need to talk about Eli Lilly dropping almost 8 billion on Centessa. We'll unpack that neuroscience multiple right after this.